Good morning and welcome to our multi-asset and equities webinar for the quarter with me, Kelly Daries. I am joined by Romelon Chetty, Equity Portfolio Manager, Shriya, Quantitative Analyst within our multi-asset team, and Bastian Teichgreeber, our Chief Investment Officer. Thank you for joining us, and as always, please feel free to post your questions as we go along, and we'll try our best to address as many as possible in the live Q&A session to follow. Basti, just to set the scene, can you please briefly describe the dominant macroeconomic drivers over the last quarter and how that has impacted capital markets?
Sure, Kelly, thank you. And thanks from us and also everyone for joining. I guess, Kelly, the last quarter or the first part of the second half of this year has been a very good one for asset class returns. So we had strong returns domestically, but also overseas. All major jurisdictions actually enjoyed quite healthy asset class returns, which is good. But if we look under the hood a little bit more detailed, the last quarter has really been a tale of two. So we started off quite volatile with the macroeconomic backdrop not being too supportive. We had US data surprising on the downside. We had initially a very weak labor market report, which led to a little bit of recessionary fears spiking. And on top of that, we also had the Bank of Japan hiking interest rates, which led to a big unwind of the carry trade. So lots of volatility, not so good news. But then markets pivoted towards September, October, as the Fed cut 50 bips instead of 25 bips. It was partly in the price, but still that was the better outcome. So easier financial conditions coming with that is a positive. At the same point in time, we now had all of a sudden way stronger macroeconomic data from the States. And we also had a big stimulus in China, which also helped the emerging market in general. So all in all, I guess a good third quarter and a good start to the second half of the year. And let's see where to from here.
Yeah, so turning to global growth, the US economy experienced a bit of a slowdown at the start of H2, and recent data has shown, it's a bit more positive. How do you track that?
Yeah, that's exactly a good point. So we use the Prescient economic indicator. That's our own in-house nowcasting tool where we really can put the finger on the pulse of the global economy. And over the last 4 years now, we have not been predicting a recession, not because we've got the crystal ball, but because we do cut through the noise. We look deeper than just looking at the headlines, and we focus on statistically verifiable facts. And if you look at the data, you will have seen that the data was never sufficiently weak to really hint towards a recession. So with that, we saw in the last webinar in July, we actually mentioned that there is a pronounced slowdown coming now, and that the end of the year will be the theme of looking for that recession to hit. But we didn't really sound too convinced that it's coming because, again, the data didn't support it yet. And we've been right on that one because since then, heading into September, October, we've actually seen quite a bit of a turnaround in the data. So this is just a non-technical overview of the Prescient economic indicator, and obviously a lot of data goes into it every single day, which we update automatically every night. And we've just grouped it here into buckets like gross private domestic investments, consumer sentiment, net exports and imports, etc., etc. And at the bottom here, you can also see a labor market section. If I just open that up, you can see there's a lot of sub-indicators going in here. And those are the ones which helped us to track that slowdown in the beginning of the third quarter, but also the re-acceleration at the end of the third quarter. So just put that into, call it some line charts because it's just easier to follow for us. And we're showing in the light blue the Prescient economic indicator through time and its estimate of, in this instance, US GDP. And then we're overlaying the real GDP prints through time. You can see that the two series track quite closely. And that's a good thing. It just means that the indicator works. If we now zoom in, then it becomes more apparent why we are doing this. So you can see that the blue line actually stops in Q2 of 2024. That's because the last GDP print which we could observe was in the second quarter of this year. But you can see that the turquoise line or the teal line actually keeps on continuing. And I'm going to zoom in a little bit further just to illustrate what I've been talking about. Just over the last 4 years, you can see that this turquoise line never dropped to below zero, and that's the reason why we never predicted a recession. So we've been quite close and accurate in terms of tracking where GDP really printed. But more interestingly than looking into the past is what's happening on the right-hand side of the chart, so the more recent history. And what you can see here is that I think here July, this is where we had our last webinar, that's where we're tracking the slowdown, hence the talk about the slowdown, but not the recession. But since then, you can see that there's a spike in this Prescient economic indicator, highlighting that we're kind of out of the slowdown already and really looking into quite a positive picture of a re-accelerating US economy.
It's interesting to see that global growth is reaccelerating. It seems we've achieved a soft landing and that we're now headed for a new upswing. What does that mean for our house view?
Yeah, Kelly, if we would stop it here and just look at macroeconomics, then we probably would be quite optimistic on asset classes because, an upswing in equity in global growth is good for equities because it supports revenue generation. Normally it also helps profit margins, so that's all positive. But we really don't stop here, so we go one step deeper, and there's quite a few headwinds actually to global asset classes, leading for us to actually take a quite conservative stance. Okay, so that's a quick summary of our house view, and as always, we're showing on the left-hand side basically the different asset classes, and then on the x-axis you can see whether we are in a strongly negative, negative, neutral, moderately positive, or strongly positive state, and the color coding obviously supports that illustration. And you can see that in the equity space, most of the tiles are red, meaning quite cautious or negative if you want to, and the only exception being South African equities. So if we look into US equities and now try to figure out why we are so negative despite that turnaround in the economic picture, you can see that the valuations are detracting quite a bit. The economic picture is also not blue skies, so there are still some headwinds. It's not that we are in real time growing substantially above trend growth, but we have accelerated towards trend growth, which is positive. So we do expect that economic indicator to keep on improving. And then financial conditions be neutral. We do still have a quite high level of interest rates in the States. Yes, the Fed delivered the first rate cut. And yes, credit spreads remain tight, all of this speaking to easy financial conditions. But again, if you have a 2.5% inflation economy right now and you're running interest rates still at 5%, still quite tight. And then sentiment, I want to spend a second on that. So you can see that the sentiment indicator is negative across the board, mostly driven by business and consumer sentiment being quite pessimistic. And we do think that part of that is linked to the upcoming US election. Okay, moving out of the States, more towards South Africa, you can see that we're taking a more positive stance here. So you can see that valuations are just way cheaper. The picture is positive. And we also have a more positive sentiment indicator. The sentiment indicator once again broken down into business, consumer, and investor sentiment. Investor sentiment, again, quite neutral. But what is interesting that the consumer and the business sentiment indicators are actually improving quite a bit in South Africa. And we would link that to the absence of load shedding, but potentially also the positive outcome of our election. Looking at the bond market, on the left-hand side, you can see that mostly a moderately cautious or moderately negative stance. The exception actually being US government bonds, which is the strongest haven asset we have. So that once again speaks towards a cautious stance. And similar on the credit space, where you can see that we are mostly very cautious with partly strongly negative views on the back of very stretched valuations, i.e. tight credit spreads here. I'm going to skip the real assets, but on the currency side, some good news. We remain very positive on the rand. If we go into the detail, we can link it again to attractive valuations, that economic turnaround which we're starting to feel, and then basically also quite positive sentiment. So for the rand, the outlook is not too terrible, even at the current levels.
Thanks, Basti. Shriya, could you take us through one of those asset classes that Basti has mentioned and just give us a little bit more detail as to what are the factors driving it?
Sure, Kelly. So as you know, we are a systematic house, and that means that any views that we make, any decisions that we make are data-driven, and so we rely on the evidence to make those decisions. Now, in the asset class view space, we rely on several indicators to determine whether an asset class is attractively priced, whether it's unattractively priced, or if it's fairly priced. So let's go into SA equities and have a look at the drivers behind this asset class. So having a look at South African equities, Bastian has taken us through the fact that we've got a moderately positive view on this asset class, and it's driven by very strong valuations, economics and global financial conditions that are currently neutral, and a very strong sentiment picture. But how do we actually get to these top-level factors? Now, I mentioned that we look at various sub-factors, and this is what you're seeing on the screen. Starting off with valuations, what we look at here are your traditional valuations ratios, so things like price to earnings and price to book. You can see that almost all of the indicators here point to attractive valuations for this asset class. However, where we have seen changes is in the price to earnings ratio. The price to earnings ratio, if you look at the period 2022 to 2023, it's remained in this area below the long-term median, which means that from this perspective, SA equities were quite cheap. However, what we saw post the South African election is that the PE ratio has actually ticked up and it's now almost at the long-term median. Now, this is because we've had quite a bit of a rally in the South African equity market, but it hasn't been supported by strong earnings. So from this perspective, from a price to earnings perspective, SA equities aren't as cheap as they were at the beginning of the year. However, we can't be biased and only look at this indicator to form a view on valuations. And that is why we look at a broader perspective, taking into account these other indicators to form our view of cheap valuations. From an economic perspective, economics overall are quite neutral, but we are seeing value from the economic surprise index. So here, your macroeconomic prints are on balance beating consensus. So for example, if GDP prints higher than what people expect, this is positive for economic growth. Global financial conditions are also currently neutral. However, we are moving towards more loose financial conditions, which is quite good for this asset class. So monetary policy, as we know, is currently tight. Yes, the Fed has started on its rate cutting cycle. So it will take a bit of time before we actually see value in this indicator. Sentiment overall, Basti did touch on the fact that it is overall very positive, and that's really provided nice tailwinds for SA equities in the second half of this year.
Romelon, on the topic of equities, it has really been a fantastic year. Can you give us a little bit more insight of what has been happening in the equity markets?
Yes, thanks, Kelly, and thanks to the viewers. So it is true the equity market has done really well this year. And despite rate cuts being deferred to later in the year, most markets across the globe, across the geographies, have hit all-time highs. So the global equity market, usually measured by the MSCI All Country Index, was up 6% for the quarter, taking the year-to-date performance to a healthy 19%. If you split it into developed markets and emerging markets, developed markets are up 6%, 3% behind the emerging market counterparts, which are up 9%. In the US, we saw the Fed do their first rate cut in late September on the back of weak jobs data. And the S&P 500 rose 6% as investors began to price further monetary easing, as well as corporate earnings were strong. In Europe, in the EU, we saw that there was weak PMI data and there was a lower inflation print. And that led investors to believe that rate cuts were very imminent. And despite slow economic growth fears, the European market delivered a 7% return. Japan returned quite differently from the developed market peers. They were down 4.4% in their local currency, and that was because of unfavorable market election results. The emerging markets return was largely driven by China, and that happened in late September. So for the last 15 days of September, China was up 27%, and that was because the Chinese government announced fiscal and monetary stimulus. That nicely trickled into the South African market, where shares like Naspers and Process benefited from their Chinese exposure to Tencent. And resources also benefited because when the Chinese economy is the uptick in the Chinese economy, resource stocks benefit because China is one of the largest demanders of resources. The other big story in South Africa, and probably bigger than equities themselves, is SA property. It's up over 50% over the last year, and that's coming from very attractive valuations and increasing positive sentiment. And the question to ask is, the South African market is very close to all-time highs. Will this continue? And as Shriya has shown, we see that PEs are close to their median at the moment, but other valuations are strong, and sentiment is currently strong. So if we see economic conditions improving and financial conditions improving, there's no reason why the market cannot reach further highs.
Thanks, Romelon. Those are some very impressive stats from the equity market. If we take it over to more of a multi-asset approach, considering some other asset classes, Shriya, something very topical for clients would be the rates. And there have been actually 2 big meetings of central banks of late. How have the markets reacted?
September was a really big month for central banks in the United States and in South Africa. It was pretty much decided that the Fed was going to cut, but the question was, were they going to cut by 25 basis points or was it going to be 50? Now, they've obviously come out with 50 basis points, and that can be considered quite aggressive. However, if you look at the data that presented itself leading up to the meeting, Basti has told us that we did see a little bit of a slowdown in global economic growth. And if you look at what the market was actually pricing for going into 2025, 50 basis points made sense. However, what's actually followed now is that the market has repriced. So let's actually look at what that looks like currently. If we look at the Fed Fund futures chart and look at the forward rate expectations 1 month ago in the lighter blue color, you can see that it's a lot more aggressive than what the current rate is. So into December 2025, the market is pricing, or the market was pricing, for around 8 cuts. However, it's repriced to now around 6 cuts. Where we can see this a little bit more clearly is if we look at this chart. So at the beginning of September, leading up to the Fed meeting, the market was pricing for around 10 cuts to the end of 2025. The Fed meeting happened and they came out with a 50 basis point cut, which equates to around 2 cuts. And then the market repriced to 8 cuts, which makes sense. However, what's happened in the past couple of weeks is that the market's repriced even further, and now we're sitting at around 6 cuts. When a repricing like this happens, we usually expect global equity markets to sell off. However, this isn't what happened. If you look a bit deeper into investor sentiment and look at the risk that's actually priced in right now, it's quite muted. On top of that, we have US equity valuations that are very extended. So this adds a little bit more color as to why we take a more cautious stance on our developed market equity positioning.
Thanks, Shriya. So I think what clients get a bit of confused about still is how something like interest rates affect our equity funds. So Romelon, can you talk us through how a change in interest rates or how they have affected the portable alpha strategy within our core equity funds?
Yes, Kelly. So interest rates do affect the portable alpha strategy employed by the Prescient equity funds. But before I explain how that happens, allow me to briefly explain portable alpha. So we know that it is a challenge for investors to get consistent market returns. And we do not want to penalize investors through bad stock selection when they've got the allocation decision to invest in equities correct. And what that leads to is the portable alpha strategy, which says the portfolio has 2 views. A beta view, which is the stock exposure view, and an alpha view, which is the cash and income view. And the beta view is efficiently obtained to give the clients the effective exposure of equities to whichever equity benchmark they wish to pursue. So we know that alpha is a difficult thing for equity managers to achieve, and we've seen that over the long term, many equity managers underperform their benchmarks. And it is a lot easier to achieve alpha in the cash space. So we port the alpha of the equity funds to the cash and income space. And that is where we invest our resources in investigating, taking economic and financial conditions into account and the current economic climate to optimally position the portfolios to excel in interest rate environments. So how does the repricing and rate cuts affect the portable alpha strategy? We've seen that through taking risk through either credit or term assets, and specifically term assets, interest rate cuts have benefited them in the last few months, and we expect that to continue. So the point is that the alpha part of the portfolio is uncorrelated with the beta point, and that's what enables us to achieve consistent outperformance. Okay, so the first block shows the equity market performance, and the equity market performance is the beta of the portfolio, and it's always going to make up the largest component of the equity funds, because these are equity funds. But where the genius happens is this alpha component, where term and credit assets are taken, credit risk assets are taken to produce this block, green block here. It may seem really small on a one-year basis, but if you accumulate this block consistently over the long term, it leads to significant outperformance.
Thanks, Romelon. So it seems from the interest rate changes, it really benefited our portable alpha strategies, and in turn has been a very strong driver within our balanced investment process. Shriya, what other sources have contributed to the amazing balanced performance we've been seeing of late?
So when we think of our multi-asset strategies, we like to think of it as the best of both worlds. And when I mean worlds, I mean the best of passive and the best of active. So on the passive side, you're getting the benefits of low fees, low transaction costs, and low tracking error. On the active side, which is what our focus is today, we have portable alpha, which Romelon has taken us through, but we also have our strategic asset allocation and our tactical asset allocation. So our strategic asset allocation, which I'll show you just now, that's where we start our process. And that's really important because that's how we position our portfolios for the long term. So we spend a lot of time on it because it explains over 90% in our portfolio variation. So what you're seeing here is our balanced fund strategic asset allocation. You can see there's quite a diverse group of assets here, and that's exactly what we believe in, diversification. Here we've got SA equities at 25%, and this is where we have exposure to the Prescient equity fund. We've also got a 5% allocation to SA property, 10% allocation to SA bonds. We also have a 5% allocation to SA clean energy and to SA infrastructure. Now these two funds are managed in-house by our credit team, and they give us a nice steady CPI plus 5 profile. We've also got a 5% allocation to SA credit. On the offshore side, 45% of our portfolio sits offshore. Now we've got 35% allocation to offshore equities and 10% allocation to developed market bonds. However, even though 45% of our portfolio sits offshore, we don't have 100% exposure to the dollar. Now, this is because when we look at currency as its own asset class, and we actually hedge back 17% of our dollars back into rands. But why would we do this? The reason is because the rand is extremely volatile, and as a South African investor investing in the United States, when you bring your dollar returns back to rands, it's impossible to perfectly time the market. So the rand could strengthen within that period, and then you're eating into your dollar returns. So I'll give you a bit more of an example. If you, as a South African investor, want to buy Apple shares, you can invest in Apple, but you'll get the return of Apple, but you'll also get the return of the dollar. And that second component is something that's commonly overlooked. So what we try to do here is that we try to protect this part of your return. What we say is that in the long term, the rand is going to depreciate against the dollar by 4%. We lock in that interest rate differential of 4%, and that guarantees that amount of return on a portion of your offshore exposure. This has worked really well for us this year when the rand unexpectedly strengthened. Before the SA election, that's not something that anybody could have predicted. Our second driver is our tactical asset allocation, and that's where we tie in the asset class views that Bastian had showed us at the beginning of this webinar. What we do there is that we adjust our strategic asset allocation ever so slightly to account for macro changes in the short term. So if you remember, we had a strong underweight in developed market equities and a strong underweight in emerging market equities. What we've done is that we've taken a little bit of exposure off of these and we've put it into developed market income, which is more attractive right now. And this explains how every single day we're able to adjust our positioning in order to be optimal given the macro environment and what's going on in the world.
Okay, Shriya, so how does this approach and the current positioning, how does it translate to the performance of the Prescient Balance Fund?
Kelly, it's been a really great year for the multi-asset team. We're really proud of what the portfolios have done over the past year, and we've been above the peer group average over every rolling period. Now, that is exactly what the fund was designed to do. We're not aiming to be the top fund in the category every single year or every single quarter. What we do want to do is to be marginally better than the peer group average, and we believe that this will lead to long-term outperformance, and I can demonstrate that. So what we can see is that the balance fund has had quite a nice steady performance up. Over the short term, yes, we do want to be marginally better than the peer group. But in the long term, what this translates into is a larger gap above the peer group. We can see that there are managers, of course, that have done really well and have finished ahead of us. However, these managers take more aggressive bets, and that's not something that we're focused on. What we focus on is consistency and the power of compounding returns over long periods of time. Where you can see this more clearly is if we look at the percentage of time spent in each quartile over rolling periods. Let's focus on the dark blue block. This represents the amount of time that the balance fund spends in the top quartile. You can see that as we extend the time period, this blue block grows bigger and bigger. And over 10 years, we actually celebrated the balance fund's 10-year birthday in May this year. You can see that we spent 100% of the time in the top quartile.
Thanks, Shriya. We are very much proud of our balance fund performance. And Romelon, a lot of that balance fund performance can be attributed to the equity building block within there. And, some people might say it's strange because we're typically known as a fixed income house. So what do you say about that?
Well, we can only laugh at the fact that we are viewed as a fixed income house or dominant fixed income house, because as Shriya showed the performance, the bulk of the absolute and the outperformance has come from the equity building block, and we don't see why that should not continue. The other misconception in the market is that the equity funds are passive tracker funds at Prescient, and that's not true. A passive tracker fund, although charges low fees, is systematically set up to underperform the benchmark. So over time, the difference between that fund and the benchmark will open up and it will be significant underperformance. At Prescient, we believe in active allocation of the capital. And with a fund fee charge of just 30 pips, we believe we can deliver consistent outperformance over the long term. And this illustration will just show how one of the Prescient funds has performed. So this chart shows the Prescient Core All Share Fund, which is targeting to beat the JSE All Share Index. And as Shriya mentioned with the balanced funds, it's the same thing with the equity funds. It's difficult to pick a manager that sits in the top quartile consistently. And as you can see, over the rolling 3-year periods, the Prescient Core All Share Fund is largely above the average manager and currently has edged into the first quartile, into this first half of the top quartile. And it just speaks testament to the strategy. If we look at this chart here, this chart beautifully shows how the strategy is meant to work. In the short term, you will see the fund behaving or having returns that are in all 4 quartiles. But as we edge and expand the investment horizon, and we know that with an equity fund, the investment horizon is 5 years plus. And as we get into the longer term performance, the equity funds at Prescient edge into the top quartiles. And with a low fee of 30 basis points, you can be assured that there will be consistent outperformance in the long term.
Thanks, Romelon. Basti, it's been a great year for our equity and multi-asset offerings, and they've done well overall, as we can see. Top of mind for clients is always, okay, so what should they anticipate? What's coming next? Could you provide a bit of an outlook of what's to come in the remaining weeks of the year? Can't believe we are almost at the end of the year, and perhaps leading into 2025.
Yeah, sure, Kelly. I guess definitely in for an interesting end towards the year and to the quarter. We mentioned that uptick in US economic growth. That's definitely something which will support markets and which will be seen as positive. But then there's just quite a few headwinds and uncertainties, not to mention the political conflict in the Middle East and the war in the Ukraine. There's certainly more uncertainty also around the US election coming. On top of that, the Fed is going to cut interest rates, but the uncertainty here is how quickly are they going to cut? And last but not least, we had this big stimulus in China, but is there more coming? Is it going to fizzle out? So a lot of uncertainty, and given where the uncertainty is coming from, given where markets or asset classes generally are priced for, some of them being priced for perfection, we guess we would say that a cautious stance is definitely the right positioning for the rest of the year.
You mentioned the US elections, which I'm sure it's on top of many minds at the moment. How do we, surely it's difficult to capture politics within our systematic investment process.
Yeah, Kelly, I will say that's a common misconception. We do actually quite well in terms of managing political events or political uncertainty, and that's because we are able to stay objective and unbiased, and also because we can quantify a lot of the emotions which go into these elections. So just to be clear, you're right, the US election is going to be quite significant for what's going to happen at the end of this year, simply because the US economy is the largest economy in the world and it's the engine room of the global world. So it will basically drive markets quite aggressively. We also often see like a domino effect when risk of materializes in the United States. It will carry over to other markets, like different corners of the world. So with that, definitely something we can't ignore. We have to keep an eye out. But I think it's also important to be realistic. Like if we just think about the 2016 elections, that was when Trump first took office. And I can remember that markets were in a steep sell-off after the news emerged that he's probably going to take the majority of the vote. Probably impossible to predict the outcome of the election. And even if we could predict the outcome of the election, it's impossible to gauge the reaction function of markets. Quite unpredictable. So we like to more focus on the facts which we can measure. So for example, we have our in-house Prescient sentiment indicator where we gauge investor sentiment, and we try to track in real time how much uncertainty is really priced into markets. That's quite possible because we can measure the cost of insurance premiums, so we can look into implied volatility surfaces, and that basically enables us to see is there a lot of uncertainty in the price or is there not a lot of uncertainty in the price. And that's a way better way to go about uncertainty in political events instead of trying to make point forecasts, which doesn't work either. Another example, I actually made it in the intro already, is to look into consumer sentiment, to look into business sentiment. We use various surveys here. We use alternative data to just understand how much is it affecting businesses, how much is this political uncertainty affecting the consumer. And that's what really matters for the economy and ultimately for markets. But so Kelly, just to sum it up, that's where we're at. As you said earlier, it was a great year for us. Certainly a lot of uncertainties out there, and with that, as I said earlier, probably justified to take a more cautious stance, but we are very sure that the systematic approach we employ is well equipped to navigate these kind of uncertain waters, and with that we know that we will carry on with the good track records which we've created in our fixed income space, in our equity space, and lastly in our multi-asset space.
So overall, like you said, Bastian, we are very proud of our equity and multi-asset products and how they have performed and what we have been able to provide for our clients. Just a reminder, what we have to offer within our equity space is our core equity fund range, employing the portable alpha strategy that Romelon has spoken to you about today. And like he has emphasized, it is not a passive strategy. So please do keep that in mind, though it may look so with our very competitive pricing. In our multi-asset team, as Shriya has mentioned today, we have the Prescient Balance Fund. We also have a Prescient Defensive Fund that is just uses the same approach, but just has a lower equity exposure. And I think what is pretty crazy but amazing for the clients out there is you can get any of these offerings at just 30 basis points per annum. So it's quite a steal. So thank you to our panelists for the insightful engagement and for clearly demonstrating, like Bastian said, how equipped we are for the future of investing. Thank you very much for joining us, and we look forward to addressing your questions.
Hi there, and welcome to the live Q&A. Thanks again for joining us, and thank you for your questions. So we are going to jump straight into it. The first one, inflation keeps on coming down in the States, and demand-side driven inflation is very slow. How does that look in South Africa?
Thanks, Chetty. I guess it's similar in a different way. So it is similar that inflation is also low in South Africa. We had 3.8 printing yesterday, so it also comes down. And it's also similar in a way that demand-side driven inflation is very low in South Africa. But that is more almost like a structural thing. So other than in the United States, where we go through heavy demand-side driven inflation when there's a proper business upswing, in South Africa, we actually generally don't see that. Our inflation is mostly driven by a lot of imported goods, like we import the oil for our petrol, we import a lot of food, And that's why the exchange rate matters so much. And then last but not least, for example, electricity prices also play a big role in our lives, not so much in the States. But here it's a big item in the CPI basket, and that is obviously administered through the government. So different dynamics, but for different reasons, but happen to also be on a trajectory downwards, which is good.
And then how do you decide on which indicators to use in your asset class views?
Yeah, I'll take that one. So it's a really good question, and it all depends on how much informative power these indicators have for the specific asset classes. So what I mean by that is that collectively, all the indicators that I showed you, for example, for SA equities, need to be able to explain the behavior in SA equities on a forward-looking basis. So it will vary depending on the asset class you're looking at. If you're looking at SA equities, you look at more specific SA factors. If you're looking at SA bonds, we lean a little bit more towards the global side. So we test all of this. It's all part of our modeling process, and it's an ongoing thing. So we're always looking at new indicators to add and to improve the process as a whole.
In September, the prime rate dropped by 25 basis points. Do you believe that was the main driver for the boost in the SA real estate? And based on the lower repo rates, what are the investment opportunities? We'll take that one.
I'll take that one. Definitely it plays an important role. So interest rates are important for properties, obviously, because of the refinancing nature, which a lot of these properties are driven by. And I don't think it was exactly that September 25 cut in the repo rate, because the cut was in the price for a long time. But I guess the repricing of the repo rate in advance, the story that interest rates are headed lower over the last couple of months, that surely has been one of the drivers. Another driver would have been also like a recovery a little bit, even if very, very small, but a little bit of a recovery in growth outlook for South Africa. And then obviously also very cheap valuations and an improved sentiment. So our process always we cite valuations, financial conditions, economics, and sentiment, but those will always be the driving forces for any of these asset classes, same class property.
Interesting. Why do we have to have a passive beta component with an active alpha component in the equity portfolio? I think, Romelon, that's your one.
Yeah, I'll take that one. So it's well known that equity fund managers struggle to beat the benchmark. I think last year S&P released some data showing that the large chunk of equity fund managers in South Africa underperformed their benchmark more than 50%. And as the time horizon increases, that percentage increases up until 100% in certain categories. That study also showed that in the cash and income asset class, that underperformance of the benchmark is a lot lower, lower than 50%. And that makes the case for the portable alpha strategy, where we want to invest our resources and time into an asset class where alpha is easier to obtain in the cash and income space. And the effect of that is a strategy that marries both the passive and active equity components and leads to lower tracking error, lower fees, lower turnover, but also has the outperformance target to beat a benchmark and allows us to put the capital of the clients to work.
And what is your view on China versus India?
Okay, so we don't really form that specific views on those individual countries. Not that we can't. Through a systematic approach, we're quite able to do that quite quickly. But we do not want to do that because we really do believe in diversification, and especially when it comes to emerging markets. The case is often made that they have become very, very different, which is very true. But that to us actually means even more that you want to diversify across the emerging markets. So there's a lot of bad news now around China, and then there's a lot of good news around India over the last couple of years, so to say, and those are all probably starting to feed through in the performance, but a lot of it is already in the price line. Market participants have been very pessimistic on China, and now Chinese equities seem very, very attractively valued. And for India, it's a little bit of the opposite. Like we've got extremely elevated PE ratios on the back of these continued positive stories. But anyway, instead of forming those individual reviews, we do think that those are both big components in an emerging market basket, and we like to access the whole basket for that.
And these two are pretty similar, so I'm going to ask them both, and then you can decide how you guys want to respond. Firstly, why are EM equities negative? I suppose leading from the previous one. but also how do you implement your view practically in the balanced fund where you are strongly negative on US equity and EM equity? Are you able to underweight? How does this change your portfolio construction?
So I think I can take that. So the first question on EM equities. So overall, we are strongly underweight, as you saw. And the reason for that is because if you look at those top level factors, so valuations, economics, financial conditions, and sentiment, on the valuation side, valuations are currently quite overextended, so quite expensive. And then sentiment as well is also negative. On the financial conditions, global financial conditions, and on the economic side, it's quite muted at the moment. So those factors are neutral. But as we know, global financial conditions are going to loosen, so that will unlock some value, and then we could see a change in the view on emerging markets as a whole. And then on the second question around how we incorporate our underweights into our portfolio construction. So I did touch on it a little bit, but essentially in our balance fund, we will only take tilts on strong conviction signals, so whether the signal is strongly overweight or strongly underweight, and we'll only tilt our SAA by a very small amount, so only by about 5%. So in this example, because we are strongly underweight emerging market equities and developed market equities, we take about 5% off our SAA exposure in those asset classes, and then we put it into something more attractive. And at the moment, it's sitting in developed market income.
Thanks, Shriya. Next one is, what happens to the performance of your equity funds during interest rate hiking environments? Do you want to take that one?
Yeah, I'll take that one. Yeah, so the first thing to account, we said that when interest rates go down, the portfolio will benefit and has benefited. But I think the first thing to remember is that our portfolios and models are dynamic. They take into account a large chunk of data with regards to economic and financial conditions through a long period of history. And when rates go up, it's like a double-edged sword where you'll feel pain in the short term due to mark-to-market movements if you have term assets. But what it means is that long-term higher yields are locked in. And as rates then come down, and as we've seen, the performance then comes through quite nicely.
And then they ask, how does the cost of currency hedge affect portfolio cost?
So it's a really good question, because if you are wanting to protect a part of your portfolio against rand strengthening, then you don't really want to pay a lot for it, because then it's going to eat into your portfolio returns anyway. So the good news is that it actually, the way that we do it, the cost is actually quite negligible. But the reason for that is because we hedge using derivatives. So we use futures or forward contracts, and those are very cost-effective instruments. But now a follow-up question might be, why doesn't everyone do it then? And I think the answer there is because derivatives are quite complex instruments, and you need to know how they work and how to trade them. And here we've got many, many years of derivative experience across the floor. And so we feel very comfortable using them. We've been using them in our funds for several years now. So it's a really good value add in our portfolio.
And then this seems to be our last one. Bastian, perhaps you want to take this one. Given that both the Prescient multi-asset and equity funds have performed well, would you say that it's still a good time to get in?
Oh, yes, obviously the answer is yes. I guess, yeah, past performance is really not indicative of future results. The question is just, where do you sit in the interest cycle? So is it still attractive for a portable alpha strategy? And the answer to that is most definitely yes, because we haven't really started to see a lot of rate cuts. We just had one rate cut, 25 pips. So there's still more to come. And as Rome explained, we don't really desperately need a cutting cycle for that strategy to perform and produce a lot of alpha. Steady state is good enough. It's only the hiking cycle where we have to be more dynamic, but we can adapt to that as well. But there's no hiking cycle around the corner anyway. So with that, yeah, very, very good outlook for the core equity strategies from an alpha point of view. And then speaking about the beta component, well, South African equities still are undervalued. So even there, we expect the alpha to do well, and we expect the beta to do well. So definitely, whatever the past performance is, yes, it has been amazing, but that doesn't mean anything for the future returns.
Okay, so thanks once again, everybody, for joining and for your questions. I hope we have answered them sufficiently. If you have any more, if you think of any more, please feel free to send them through to us. You can reach out to any of our respective business development managers. Feel free to visit our website. And if you can't find what you're looking for there, please do reach out. But other than that, please enjoy the rest of your day, and we look forward to engaging further.